Welcome to the Depth Dive. Today we're digging into a stack of source material on T-Mobile US, specifically their recent Q3 2025 earnings report, ticker TMUS, of course.
That's right. And if you follow the telecom space, you know T-Mobile's been the growth leader for a while now.
Absolutely. So our mission here is to quickly cut through all the data, all the analyst notes, and really get to the heart of this tension we're seeing. It's
Yeah.
this phenomenal operational strength they're showing versus some very real rising financial pressures.
The classic investor dilemma, isn't
Yeah.
it? Do you bet on that amazing customer growth continuing, or do you focus more on the immediate bottom line, the profitability?
Exactly. And T-Mobile's Q3 numbers really highlighted that split. Great on the growth side.
But maybe a bit more cautious on the profit side. And that's why the stock reaction was pretty muted, right? Down about 1%, even with headline beats.
Yeah, the market seems nervous about how much it costs to win like this. Okay, so let's ground ourselves in the key numbers first. Q3 2025. T-Mobile reported total revenue of $21.96 billion, a slight beat.
Right, but the core service revenue, that's the key number, money just from wireless plans hit $18.2 billion. That's up almost 9% year over year. Strong growth.
That 9% really is the engine, isn't it? Shows they're grabbing market share.
It absolutely does. But like you said, when you look at profitability, you start to see the squeeze. Adjusted EPS came in at $2.41.
And net income was around, what, $2.71 billion?
Yeah. And the point is that profit growth isn't really keeping pace proportionally with the revenue jump.
Okay, and this is where it gets really interesting, I think. It points to the sheer scale of investment needed to keep that lead.
You mean the capex?
Yeah, capital expenditures. The money spent on building and upgrading the network, it hit $2.6 billion just in Q3.
Wow, that's up, what, 35% from last year?
Exactly. And because of that, management actually raised their full-year capex forecast. They bumped it up from $9.5 billion
To a huge $10 billion.
$10 billion. That massive investment number is really the big question mark hanging over this whole earnings report, I'd say.
Agreed. It sets the stage for everything else.
But, that huge investment, it is clearly driving incredible results on the ground. Let's talk about the operational wins, the good part of the story.
Okay.
T-Mobile is just continuing to dominate in attracting those high-value customers. They added over 1 million new postpaid phone customers. That crushed estimates.
Yeah, over 1 million postpaid ads. That's a massive figure. Because we're not talking prepaid here, right? These are the contract customers.
The ones with higher ARPU, average revenue per user, the ones who stick around.
Exactly. They drive the future cash flow. Adding 1 million of them suggests T-Mobile's mix of network quality fueled by that capex plus their deals and brand. It's just working. They're taking customers from competitors.
And it's not just phones anymore, is it? They're making serious inroads into fixed broadband.
Oh yeah, the fixed wireless piece. They added about 506,000 high-speed internet customers in the quarter.
500,000 home internet customers in 3 months. That's a significant move into territory usually owned by the cable companies.
It's more than just diversifying revenue streams, though. It feels like strategic warfare, almost.
Oh, so.
Well, fixed wireless broadband is potentially a very high-margin product for T-Mobile. They're leveraging their existing 5G network capacity built primarily for mobile.
So the incremental cost is lower.
Potentially, yes.
Yeah.
Every home internet customer, they add chips away at the cable and fiber incumbents. And they're doing it fast.
Okay, so all this momentum, the postpaid ads, the broadband growth, it gives management the confidence to raise guidance and, well, keep their foot on the accelerator.
Which brings us back to that $10 billion capex forecast. It's not just a number. It signals real conviction.
Right. They clearly believe that spending big now on 5G, on network density, will pay off down the line, especially when you factor in potential synergies from things like the U.S. cellular assets they picked up.
They're betting big on the future payoff, that's for sure. Okay, so that operational strength is definitely the good news. But let's pivot now to those financial friction points, what we call the bad.
Right, the costs.
Yeah. What's really striking is that gap we mentioned between the top-line growth, the revenue, and the bottom-line profit.
So when you say profitability isn't scaling proportionally,
It means that for every new dollar of revenue they bring in, a larger chunk of it than before is being spent just to get that revenue. Their cost of growth is rising, essentially.
but hang on, if they added 1 million high-value postpaid customers, wouldn't that big injection of quality subscription money start offsetting these costs pretty quickly? Why the market caution, the stock dip?
That's a fair question. It's about timing and the nature of the costs.
Yeah.
The costs hitting the books right now are immediate and pretty substantial.
Okay.
Whereas the full lifetime value of those million new customers, that plays out over several years. So there's a mismatch in the short term.
What kind of costs are we talking about specifically?
Well, several things are eating into margins. First, you've got integration costs. They're still absorbing assets like parts of that U.S. cellular deal.
Integration isn't simple, right? What makes merging telecom assets so complex and costly?
Oh, it's multifaceted. You're potentially merging different IT systems, like billing platforms, that's huge. You're sorting out overlapping spectrum licenses, maybe physically moving network gear, blending different company cultures.
Right, lots of moving parts.
Exactly. And these things often trigger big non-cash charges immediately, like higher depreciation. Plus, there are real cash costs for IT upgrades, restructuring, and so on. All that hits short-term profit.
Makes sense. And beyond those internal costs, there's the external pressure cooker of the market itself, the promotional treadmill, as you called it.
Yeah, the U.S. wireless market is hyper-competitive. To keep adding subscribers at that incredible rate, T-Mobile has to keep offering aggressive deals, right?
Like paying off your old phone, free lines, things like that.
Precisely. And every time they run a big switch and will pay off your phone promotion, that payout is instant margin compression. They're essentially trading some of today's profit for tomorrow's customer.
It's necessary to win share, but it definitely puts a lid on short-term EPS growth.
Absolutely. And that explains the market's caution. Even a small 1% dip after such strong operational results. It tells you investors are weighing that high cost of growth and the future margin uncertainty pretty heavily. It overshadowed the subscriber wins for some.
Which leads us nicely into the key risks and the uncertainties that kind of justify that market nervousness. And really, it all comes back to that huge spending plan, the $10 billion annual capex commitment. That's the biggest risk factor highlighted in the sources.
It's definitely an aggressive number. But what does a poor return on investment, or ROI, actually look like in the telecom world? What's the practical impact if the bet doesn't fully pay off?
Well, the nightmare scenario is essentially stranded assets. T-Mobile is pouring billions into building out 5G network density and coverage, especially in that crucial mid-band spectrum, which gives you the speed and capacity.
Right. Now, if subscriber growth, particularly that high-value postpaid growth, were to slow down significantly, or if the average revenue per user, the ARPU, doesn't climb as much as they hope,
Then what?
then they could end up with a whole lot of expensive network capacity that isn't generating enough revenue to justify the build cost. It sits underutilized.
And that hits free cash flow directly.
Exactly. Which could then limit their ability to do things like buy back shares or increase dividends down the road. It's a massive bet.
Yeah.
And getting the timing or the demand forecast wrong has big consequences.
And it's not just their own spending decisions creating risk, right? There are external threats, too.
Oh, definitely. The competitive landscape is, well, brutal.
Right.
You got the cable companies getting much more aggressive with their mobile bundles, often undercutting the main carriers on price.
Right, using their existing broadband relationships.
Yeah. And then there's always a possibility of regulatory scrutiny. If T-Mobile gets too dominant, could regulators step in? All these things, competitor pricing, regulation could force even more pressure on their margins.
Okay, and one more factor mentioned was leadership transition.
Right. The incoming CEO, Srini Gopalan, takes over November 1st. He's the former COO, so it's an internal promotion, which is generally seen as stable. But any change at the very top introduces a degree of execution risk, especially with such a massive, critical, strategic initiative like the $10 billion network build-out underway.
So the market just wants to see smooth sailing under the new leadership.
Pretty much. Investors tend to be a bit cautious until that continuity and stability are clearly demonstrated. It's just another small layer of uncertainty.
Okay, so we've got this really powerful conflict here. Market-leading growth, amazing subscriber numbers, but fueled by incredibly aggressive investment that's squeezing short-term profits. How do the pros, the market makers, the big institutions actually process these conflicting signals? What's the view from the trading floor, so to speak?
Well, from an institutional perspective, especially for someone providing liquidity, you'd expect a pretty clear tension in the order flow. It's almost predictable.
How so?
On one side, you have significant buying interest. These are the long-term institutions, maybe growth funds, totally focused on that subscriber momentum, the fixed wireless opportunity, basically betting that growth wins out in the long run.
Okay, the growth bulls.
Right. But then, on the other side, you have sell orders, maybe some profit-taking, maybe value investors, who are just spooked by the current profitability squeeze. and that huge capex number.
The cost-conscious sellers.
Exactly. So it creates this constant tug-of-war in the market between the growth narrative and the cost narrative.
And that leads to
Volatility, potentially. You might see these short-term battles, maybe intraday squeezes, where algorithms try to capitalize on small shifts in sentiment. It can lead to rapid price swings, even if the underlying news hasn't changed that much. That tension creates choppy trading conditions.
So if you're running a professional trading desk and you want to manage your exposure here, how might you hedge against that specific risk around T-Mobile's margin concerns?
Often you'd look at sector correlations. If T-Mobile is facing margin pressure, partly because of intense industry promotions or broad economic factors.
Then competitors are likely feeling some of that heat too.
Precisely. So one common hedging strategy might be to take positions in competitor stocks, maybe Verizon or AT&T, or even short a broader telecom sector ETF.
So if the whole sector gets squeezed on margins, the hedge offsets some of the T-Mobile specific risk.
That's the idea. It helps isolate whether T-Mobile's problems are unique or industry-wide.
Okay, that makes a lot of sense. So for listeners trying to track this story going forward, what are the absolute key things to watch in the next quarter or two? How will we see this tension playing out?
Right. Actionable takeaways. First, keep a very close eye on the Q4 subscriber guidance and the actual results. Does that million-plus postpaid momentum continue, or do we see any signs of slowing after all these promotions?
Makes sense. What else?
Second, ARPU. Average revenue per user. Are the new customers they're adding spending more, or are they mainly coming in on deep discounts that dilute the average? We really need to see ARPU stabilize or ideally tick up to help those margins.
Got it. Subscriber growth quality, not just quantity.
Exactly.
Yeah.
And finally, watch the analyst revisions very closely. Now that the $10 billion capex is locked in for the year, analysts will be updating their models.
Specifically, their free cash flow forecasts.
Yes. If you see analysts start trimming their free cash flow estimates for future years, that's a direct signal the market is getting more concerned about the return on that massive investment. That's a key indicator to watch.
Okay, so let's try to wrap this up. What does this all mean for you, the listener, trying to make sense of T-Mobile? Well, picture is pretty clear, isn't it? T-Mobile US is undisputedly the growth leader in US telecom right now.
Operationally superior, no question. Adding high-value customers like crazy, making big moves in home internet.
But, and it's a big but, this success isn't coming cheap. It requires this incredibly aggressive, high-risk capital spending program.
That $10 billion number again.
Right, and that spending is putting real pressure on profits in the short term, which is exactly why the market gave a cautious nod, not a standing ovation, to these otherwise strong results.
Yeah, the sources really hammered home the sheer size of that capital commitment, $10 billion a year for network build-out. And it raises a really important question for you to think about as you watch T-Mobile going forward.
Which is?
How fast, and maybe more importantly, how sustained does that subscriber growth need to be? Not just for one good quarter, but year after year, to truly justify spending at such a high-stakes, high-risk level.
And when does that aggressive spending finally translate into substantial free cash flow growth?
Exactly. That's the core calculation. Answering that question will ultimately determine T-Mobile's long-term value story. It's a key thing to keep watching.